Alright guys, welcome back to my YouTube channel. In today's video, what I'll do is we'll do a different kind of a video. I'll talk about uh, my swing trading setup in in brief. Alright, because a lot of you have been asking me about it. You've been asking doubts about it. So I'll discuss a few points which you need to keep in mind to make a very effective swing trading setup. Alright. So the first and foremost point is whenever you're taking a stock, whenever you're choosing a stock, the stock has to be trading around its previous high. Right? It can be the all-time high. It can be the 52-week high as well. It doesn't really matter. The stock should be trending in a direction for multiple weeks, and it should be trading around these previous highs. Because whenever the stock corrects, right, and suppose there is some base building going on here, right? So what happens is until and unless this supply is tested out, you are not sure if the stock will move big or it will just form a top like structure here, maybe fake out as well, and then start dropping down, right? The first and foremost thing which you always need to keep in mind is that the biggest moves only come above the highest high or the lowest low if there is a downtrend in that case. All right. So what you have to do is first you have to look for stocks which are constantly trying to break through their previous high. Now, when we have this first filter along with us, right, we'll have two kinds of situations. All right. The first situation will be something like this, where the stock goes up, right? The stock goes up here. It comes back in a normal lower low, lower high pullback. It goes deep into the previous move. All right. Goes deep into the previous move, and then an elaborate base is formed here, right? What do we mean by an elaborate base? You'll see a base for multiple months is formed here, right? In this kind of a scenario, the move which you'll get here will be pretty big, right? Because we have spent a lot of time sort of reaccumulating the stock, right? So whenever the market is all right and the volatility is low, you will see that these kinds of stocks tend to move really big. Now the other structure which you'll see is you will see that the stock goes up, and then it comes down here, right? It comes down here, and it goes back straight up, right? And suppose it dips down, and then we start going back up again. So here, if you see, where is the majority area of the base, right? What do you mean by majority area? The area where price has spent the most time. It's somewhere here. Price has been sideways here for the most time. In these prices, price has already staged an up move, right? Price has already given a previous up move. So when this kind of scenario shapes up, it means that you're buying very far from the previous low of the base. So suppose if you're buying here, you're buying quite far from the previous low of the base. And compared to this one, the majority area is spread throughout this range. All right. So if you're buying here, you're not actually buying far from the base. All right. So hopefully this difference is clear. That is why you'll see these breakouts, they will tend to fail because it has already moved 10-20% from the range. All right. The major build up area. All right. In this kind of scenario, it has just started to move out. So you'll see this will give a bigger, better move when compared to this scenario right here, right? So this is the first point which you need to keep in mind. You need to look for compact structures around these areas, right? And you need to avoid structures which look like this. Now, sometimes I'll take these structures, and that is only one specific scenario where you will see that the market is recovering from a big fall, right? And then some stocks are trying to break out, right? Something like this. So this is the only time when I'll buy these extended structures. All right. So this is one scenario where I prefer to buy these structures because they are the leaders. They're trying to break out before everything else. All right. So this is one specific scenario where I'll take this. In all the other scenarios, I'll only prefer to take the structure one right here. This one. All right. So it's very important that the stock is trying to break through the previous highest supply. Nothing inside, right? No slanting lines, all of that stuff. Nothing really matters. You always look at swing points, highs and lows, all right, or bases, of course. So first, this should be tested, and then you can use your entry model to enter in the stock. So suppose if I take an example, let's just take an example. Let's look at a few stocks. All right, let's look at this Thermax example, right? People in my group we're trading this. So see, what is the first point? When the stock is pulling back, I've marked the highest supply. So sorry. So I've marked the highest supply. So I want to see that the supply is being tested. Now see, when the supply is being tested here, the stock is already very far from the low of the base, right? This is the actual area where the accumulation happened. You see all the sideways movement. So now we are very far. So we are not buying in this area. All right, we're letting the stock pull back. We're letting the stock pull back to some previous demand zones. All right. Now the video on demand supply zones, I'll release it probably next week, so you can subscribe for that as well. All right, and make sure you like and share the video as much as possible because it helps with the motivation of continuing to teach. Right. So now if you see it, it's pulling back, and now when it starts to break out above this pivot on the hourly chart, if you see when it starts to break out above this pivot right here, then you can be confident of a bigger up move, and your stop in this case is very small, because if you bought here, if you bought in this area, your stop would have been below the previous base, which is somewhere here on the hourly chart. So look at the distance of your stop loss. Right now here, your stop distance is smaller, comparatively much smaller, and that makes a big difference in your risk to reward ratio. All right, so this becomes your entry and this becomes your stop loss. Now these breakouts will work, but only when the market is stable. All right, so always watch the index. So suppose if I watch the index right now, see, if you see, it's sideways for the past 3 days, right? That is why you'll see some stocks breaking out. But when this kind of a situation is building up and where the index is pressuring towards the lower side, and you see all these zones getting taken out very easily, and this supply is actually holding, this green candle right here is the supply, it's actually holding. You see, it went up, this wick right here went inside, and then it started to fall, right? So the supply is actually holding. So here, in this kind of a market scenario, there is some bearish sentiment building up, right? So in this case, your breakouts will tend to fail more, right? Almost all breakouts are working out in this area when the market was setting up for the next up move, and this area as well when it was taking out this supply. So you have to time your entries with these market conditions as well, and then you can get your big moves. All right. So that is a brief introduction to basic swing trading. I'll release more videos on this. This is a part one, and if you're still sticking around, make sure you like and drop a comment on this video. So I'll see you guys in the next video, and have a profitable day tomorrow.